Hi, I'm Matt Armstrong, a financial advisor at Savant Capital Management. I'm here to welcome you to Savant Backstage, a video series that will give you a behind-the-scenes look at what we do. Our goal with this series is to help you build your ideal future by providing you the tools and information you need to become a better investor. Today's topic consists of a series of videos that describe our 5 diversification strategies. We covered these briefly in our Building Better Portfolios introduction. But now we'll take a more detailed look at the reasoning behind each piece of the portfolio. And now your host, Gina Beall.
Hello, I'm Gina Beall, and I'm a member of Savant's Investment Committee and Research Team. I hope you've already listened to the high-level video of how we build better portfolios at Savant, and are back for more detail in this segment. I'm going to give you some brief detail about how and why we layer in a defensive bond strategy as the first of 5 strategies we employ in portfolio construction. The key word here is defensive, as the main goal for bonds is to preserve capital and provide income. In order to create this defensive bond allocation, intermediate and short-term bonds are blended with inflation-protected securities, also known as TIPS, and foreign bonds to build our 4-part strategy. This 4-part mix protects against a variety of adverse market conditions, from a weak economy to inflation and/or deflation. Across each of the 4 components, the focus is on high-quality bonds, a key aspect to a defensive stance. So why do we do this? This chart shows how high-quality bonds performed during past bear markets for stocks. Look at the most extreme example in the middle, when high-quality bonds rose 32.7% during the 2000 to 2002 period when the tech bubble burst for stocks. And most recently on the far right, when the U.S. debt was downgraded in 2011, high-quality bonds rose 9.5%. You might be wondering why there is a focus on short and intermediate-term bonds. Historical evidence has shown that long-term bonds, such as those with 20-year maturities, do not compensate investors for extending the maturity and taking more risk. By risk, we mean level of volatility. However, simply holding cash will not solve the problem either, as cash or bonds with less than 1 year in maturity earned far less than those with longer than 1-year terms, even though they incurred similar risk. So as a result, we believe the focus on short and intermediate-term bonds is optimal because it maximizes return for the level of risk incurred. Now for a few words about the other 2 components before we close. TIPS offer additional diversification in the bond strategy, as they have low correlation to other bonds as well as stocks, particularly during periods of high inflation. And lastly, foreign bonds make up the final piece of a truly diversified bond portfolio. By holding bonds issued by countries outside the U.S., it expands the opportunity set, insulates the portfolio from interest rate risk and inflation in the U.S., and adds an asset class with low correlation to other asset classes. That concludes our discussion of our defensive bond strategy. Thanks for watching this segment. Please be sure to check back in for the next segment in this series. If you have questions or would like more details on this topic, please contact us by emailing your questions to info@savantcapital.com or by visiting our website at www.savantcapital.com/EBI, where you can download a copy of our evidence-based investing white paper. You can also call us at 866-489-0500 to request a free copy of that white paper.